Hi guys, so we are back with another video lecture as a part of Fast Track series for RBI Grade B 2018, which has been brought to you guys by EduTap. Now we have been working in this direction for the past few years and we have been blessed with some of the very amazing results in the past few years. Now in RBI Grade B 2017 results, 124 of our students, they reached the interview stage and 27 of the students, they made it to the final list. Now apart from the different other courses which we are running, we are offering these courses for RBI Grade B 2018 examination. So these are the different courses which you guys can choose from. So there is a wide range of courses and you can choose according to your requirement. Also we are running presently discounts on the EduTap courses. So the subscribers of 2017 courses, they can get a flat 30% discount, and for this they have to drop a mail at deepak@edutap.co.in. And the new subscribers, they can get a flat 20% discount using the coupon code of 20. Now in case you need to know more, you have any query, you can always visit our website, which is www.edutap.co.in, or you can drop us a mail at deepak@edutap.co.in, or you can call us at 8146-207-241. So let us start our discussion on some of the very important questions on finance. So let's start with the first question. Which of the following committees has recently suggested a draft debt management and fiscal responsibility bill 2017 to replace the earlier Fiscal Responsibility and Budget Management Act, that is FRBM Act 2003. So this is about a recent committee which has suggested a draft debt management and fiscal responsibility bill to replace the earlier FRBM Act of 2003. So the options are Vijay Kelkar Committee, NK Singh Committee, Urjit Patel Committee, Nachiket Moore Committee, or none of the above. Now to answer this particular question, we must be aware about the current affairs which are in news pertaining to fiscal responsibility and budget management. The most important committee relating to this is the NK Singh Committee. Now this committee, it was constituted by the government in 2016 and it was headed by Mr. NK Singh, and the terms which were set for the committee, they included to review the working of the FRBM Act for the last 12 years. So earlier what happened, the fiscal deficit of the country as it was increasing, we formulated this FRBM Act in order to put some curbs in place in order to manage our fiscal deficit in an efficient way. Now this committee looked into the FRBM Act, whether this act has been successful or some changes are required to be made in this particular act. Now another important term was to define the need and feasibility of assigning the fiscal expansion or contraction with credit contraction or expansion respectively in the economy, whether we should measure fiscal deficit in terms of credit or not. So this was another key terms of this committee. It also seeks to examine the need and feasibility of having a fiscal deficit range instead of a single fiscal deficit target. So earlier what was happening, we had a single fiscal deficit target. For example, we set the target that we have to achieve this much fiscal deficit by 2018. So now what this committee was looked into is, where instead of putting in this 3%, we should put it 2.8 to 3.2%, whether a range can be set for fiscal deficit. So this was another term of this particular committee. Now recently this committee has submitted its 4-volume report. Now the key recommendations of this particular committee are as follows. So this committee has suggested a draft debt management and fiscal responsibility bill 2017 to replace the earlier FRBM Act 2003. So this is very important that this committee has suggested a draft debt management and fiscal responsibility bill. So from here you can see that the focus has shifted towards debt management, because this is the first word which has been put, and the fiscal responsibility is another important term, but it has been put secondary to debt management. Now, so this says that government should use debt as the primary target to fiscal policy instead of deficits. So the focus of this committee is on using debt and debt management as an indicator of fiscal health of the economy. Now it says that the government should set a target of 60% debt to GDP ratio, and it says that this target is to be achieved by 2023, and this 60% is to comprise of 40% limit for the center and 20% limit for the states. So higher limit will be for the center and lower limit will be for the states, and this limit is to be achieved by, this is very important, 2023. Now this also suggested that the government should create an autonomous fiscal council. So it suggested that an autonomous fiscal council should be created, and this fiscal council is to be in active touch with the fiscal scenario of the economy, and it is going to prepare fiscal forecast. It is going to recommend any changes which are to be made in the fiscal strategy of the government or on any other related matters. The government can also deviate from the path on the advice of this fiscal council. So it may happen that there may be some extreme case of national security, war, calamity, or etc. And in this particular case, we may feel the need that we may breach the fiscal targets which we have set. So in this particular regard, the advice of fiscal council can play a key role. So this is about the key recommendations of the NK Singh Committee. So now we can easily answer this particular question, that the committee which was constituted recently and which has suggested a draft debt management and fiscal responsibility 2017 to replace the FRBM Act 2003, it is none other than NK Singh Committee. So answer is going to be option number B, NK Singh Committee. Now let us move on to the next question. Cash flow from which of the following activities would be classified as cash flow from financing activities in cash flow statement of a concern? So this cash flow statement is part of the financial statements of a concern, and this cash flow statement is divided into many parts. They are cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, and in the end we just sum these all three activities, and then we try to reconcile the opening and closing balances of cash and cash equivalents. So this is the cash flow statement in brief, and here we are being asked that which of the following activities it would be put under the cash flow from financing activities. So the options are cash receipts from the sale of goods, rent and administration expenses, cash advances and loans made to third parties, cash proceeds from issuing of shares, or none of the above. Now to answer this particular question, we must have the basic understanding of the cash flow statement and the three major heads, how these three major heads are different from each other. If this is something which we are clear at, then we can easily answer this particular question. So let us first look at the basics of this cash flow statement. Now whenever we talk about or we look at the financial statements of any company, and suppose if you're asking say the ITC Limited, okay, ITC Limited, I need your financial statements, then that company is going to present you the statements which are going to comprise its balance sheet, its income statement, its cash flow statement, and its notes to accounts. So the balance sheet is a statement of assets and liabilities of the ITC Limited, and the income statement, it shows the profit and loss from the operations of ITC Limited. This cash flow statement, it talks about the cash flow, how the cash is moving in the company, how cash is being collected or how cash is being dispersed in different operations of the company. And then there are different notes to accounts which tell out how we have to interpret the different financial statements of the company. Now our topic of discussion here is cash flow statement. Now this is the statement which is going to show you the inflow and outflow of, this is very important, cash and cash equivalents. So in the exam we may be confused by this term cash and cash equivalents, and we may feel that this shows only the inflow and outflow of cash, but this is not true. We have to consider both cash as well as cash equivalents in cash flow statement. So we talk about the inflow and outflow from various activities of a company during a specific period. So a period is set and different activities are divided, and we try to analyze how different cash flows have taken place in different activities of the company. So here you can see the three activities into which the cash flow statement is divided. These are operating activities which are related to the core operations of the company, and then there are investing activities in which we look at the different investments which the firm or the company has made, or the different investments which the firm has sold or liquidated. And then there are financing activities which talks about the sources through which the firm is raising money. So these are the three broad activities. Let us look at some of the examples of each one of them. So under the operating activities, we have the core operations. So it includes the cash which you are collecting from sale of goods or services, cash which you are paying for purchase of goods or services, cash which you are paying to your employees or in order to meet your operating expenses and to pay taxes. In investing activities, we will consider the purchase of property, plant, equipment and other investments which we have made, and the cash inflow from investing activity is going to be sale of similar things, sale of property, sale of plant, sale of equipment or sale of any other investments. Also, if you are receiving any kind of income on the investments which you have made, then again it is going to be classified as cash flow from investing activities. So suppose if you have received interest and dividend on investment, this is investing activity. Now next is financing activity. Now under the financing activity, we are going to talk about the sources from which the firm is raising revenue. So for example, if the firm is issuing shares and it is raising revenue, this is financing activity. If the firm is issuing debt or the bonds, this again is financing activity, or if the firm is taking some loans, this is again financing activity. And if the firm is repaying the loan, firm is redeeming the debentures, or firm is doing buyback of equity shares, this is financing activity. And again, if the firm is meeting its obligations on those securities, for example, if it is paying interest on those particular bonds, it is paying dividend to the shareholders, this is again a financing activity. So this is about the three heads under the cash flow statement. So now we can easily answer this particular question. That the cash proceeds from issue of shares are the one which are going to be classified as cash flow from financing activity. Now if we briefly try to classify all of these, then the cash received from sale of goods, this is going to be operating activity. Rent and administration expenses, this is again going to be operating activity. Cash advances and loans made to third party, this is kind of an investment, so it can be classified as an investing activity, and if this is the business of a firm, then it can also be put into operating activity. And the cash proceeds from issuing of shares, this we have just seen is a financing activity. So the answer to this one is option number D. Now let us move on to the next question. A company has decided to issue a bond of face value 100 at 100 itself. So the face value of this bond is 100 and the issue price, it is again 100. The coupon rate is 15%. So this means that we are going to pay interest on this bond at the rate of 15%, and the duration of the bond is 7 years. So the firm is going to be using this money from the bond for 7 years, and after the end of 7 years, the firm is going to repay this particular money. And we have to find the required rate of return or cost of capital after tax if the tax rate is 50%. So in this question there are many issues. First we must understand what is the cost of capital of debt, and then we must understand, do we get any tax benefit on issue of debt, and if yes, what is going to be the after tax cost of debt. So let us try to analyze all these issues before jumping on to the answer. Now when we talk about the components of capital of a company, so these are the components from which the firm is raising money, then there are three main components which include debt, preference shares and equity. So these are some shares, and equity are the owners of the company. Preference shares are also part owners of the company, and then there is debt, which is simply loan for the company. Now in this particular question we are going to discuss about cost of debt. Now if we talk about debt can be either irredeemable, which is not going to be repaid during the lifetime of the bond, and it can either be redeemable debt, which is to be repaid after a specific maturity period. Now this can be that the debt has been issued at par, or it can be that the debt has been issued at premium or discount. Now in our case, the bonds have been issued at their face value. So in this case, the cost of debt which we have to find is the one which has been issued at par. And then again there can be a question of after tax or before tax. So this is our target area, this is our focus area. So this means the cost of debt issued at par, it means that the bonds of face value of 100 are issued at 100 itself. So this is the case which we are going to cover. This is the case which has been asked in the question. Now these are the very easy formulas which we are going to apply in solving this particular question. Now these are the formulas which you may not even try to remember, or you may not even try to cram. This is the formula which you can derive from your basic understanding only. So if you talk about the cost of debt which has been issued at par, and for now we are ignoring tax. So in this case the cost of debt, it is going to be interest divided by the price of the bond. So if you are paying 10 rupees on the bond of the face value 100, you have issued it at the price 100, and again you are going to redeem this one at 100 at the end of specific time period. So your cost is nothing but the 10 rupees which you are paying for the 7 years. So your cost of debt is going to be 10 divided by 100. So this is really simple. This is some conceptual thinking, and if you are able to understand this one, this is going to be really easy. Now then again, there can be the issue that you have to calculate this cost of debt after tax. Now what happens is, whatever this interest, that is 10 rupees we are paying on this debt, this is deductible when we are trying to compute the tax liabilities, the income tax liabilities of the concern. So this means we are going to enjoy some tax advantage by issue of debt, which is not available in the case of preference or equity shares. So then again, this means that the actual cost of borrowing is lesser than the stated rate of interest. So the rate of interest was 10%, but since we are getting tax benefit of the same, this interest is being deducted for computing our tax liability. This means our actual cost of borrowing is much less. Okay, now we have understood this cost is going to be less, but how much less? We have to use some formula, we have to use some thinking in order to derive the actual cost of debt after tax. Now this is really simple. If you have found the cost of debt before tax, you just have to multiply it by 1 minus tax rate. This means that this is your cost of capital after tax. This is very simple. So for example, if the tax rate is 30% and you have calculated the cost of debt before tax as 10%, this means this is going to be 10 into 1 minus 0.3, that is 7%. So your cost of debt is actually going to be lower. It is going to be lower than 10%, that is 7%. Now let us try to apply the concept which we have just understood in the given problem. Now first we try to find the cost of debt before tax. Now in our case, we were given that the interest is 15% and the issue price is 100. So in our case, this cost of debt before tax, it is going to be 15 divided by 100, that is 15%. Now when we have to do after tax, this means that we have to do a cost of debt before tax into 1 minus tax rate. Now in our question, the tax rate was given as 50%. So we are going to do simply 15% into 1 minus 0.5. So this is going to give us 7.5%. So our actual cost of debt is going to be much less because of the tax advantage. It is going to be 7.5%. So hence we can derive the answer, that the answer is going to be option number C, 7.5%. Now let us move on to the next question. The process of a mutual organization owned by its users, members, converting it into a company owned by shareholders is called, options are demutualization, unmutualization, co-stocking, mutual listing, none of the above. Now this is a question which has been asked in RBI 2017 examination, and to understand this particular question, we must have some basic understanding about the important concept of demutualization. Now demutualization, this is quite simply the process through which any member owned organization is going to be converted into a shareholder owned company. So suppose there is any organization and there are some members of this particular organization. Now what you do, you give the members shares, you give the members some rights, and you convert the organization into company. This is demutualization. Now the idea of this demutualization is to change the structure of the organization. This is especially prevalent in the case of stock exchanges, in which the owners, that is brokers, were also having trading rights. So this created a sort of a conflict of interest, and this situation was not commensurate with the development of stock markets. So that is why demutualization took place mostly in the stock markets in India, and this demutualization led to conduct of commercial business of the organizations, which would try to make a profit just like any other normal entity. And also now a board of directors would be put in place which will look after the day-to-day operations of this particular concern. So if you talk about the demutualization of stock exchanges in India, what happened was, earlier the same person was having the ownership and the trading rights. So the broker was also the owner, and this was something which was not desirable. So what we did, we went for the demutualization of stock exchanges, and we separated the ownership rights from the trading rights. So this is what demutualization of stock exchanges means. Now in India, demutualization of stock exchanges was mandated by the government. So this was mandated by the government in order to end the brokers' control over the stock exchanges. For this purpose, the government passed an ordinance and it made the demutualization of stock exchanges mandatory. And what happened earlier was the exchanges, they enjoyed both ownership and trading rights to same persons. Now the demutualization separated the two rights. Owners were given shares, and there was trading rights were separated, and they had to pay separately if they wanted to acquire trading rights, and several restrictions were put in place to ensure that the brokers' control over the exchanges ends. So now we can easily answer this question. This one seems very easy now. The process of a mutual company owned by its members converting into a company owned by shareholders, it is demutualization. That is option number A. Now let us move to the last question of the day. Which of the following is incorrect regarding liberalized remittance scheme of RBI? Now this is the scheme which has recently made the headlines, and a question is probable from this scheme. Now let us try to analyze which of the following is incorrect about this scheme. So the options for this one are: LRS, that is liberalized remittance scheme, is a facility provided by RBI for all non-resident individuals. Under liberalized remittance scheme or LRS, eligible individuals can freely remit up to certain amount in terms of US dollar for both current and capital account purposes. The scheme was introduced in February 2004, and its regulations are provided under FEMA Act of 1999. At present, the LRS limit is US $250,000 per financial year, or none of the above is incorrect. Now to answer this particular question, we must have basic understanding about this particular scheme of RBI, that is liberalized remittance scheme. Now this liberalized remittance scheme is a facility which has been provided by RBI, and this facility has been provided to all resident individuals, including minors. So this is the facility which is there for resident individuals, including minors. Now under this facility, resident individuals, including minors, they can freely remit a certain amount of money in terms of US dollar for both, this is very important, for both current and capital account purposes. So here we may try to get confused in this particular paragraph only. The examiner may try to confuse us by saying that this is only for current account, this is only for capital account, but this is not so. It is for both current and capital account. And then it may say that minors are not allowed this facility, but this again is going to be false, as minors and all resident individuals are given this particular facility. Now what happens under this particular scheme? Individuals can make remittances for overseas education, for travel, for medical treatment, for maintenance of relatives living abroad, and for gifting and donations. So these are the different uses to which the money which is remitted can be put to by the individuals. Also, the remitted money can be used for purchase of shares and property as well, if the required conditions which have been laid down are satisfied. Now, other important key features about this scheme, they are that the scheme was introduced in Feb 2004. Its regulations are provided under FEMA Act 1999, and at present the limit under this scheme for all resident individuals, including minors, is US $250,000 per financial year. So these are some of the very important factual information about this scheme through which the question may be formulated if the examiner is trying to judge your knowledge on some static concepts about this particular scheme. Now also there are some restrictions which are there under this scheme. It means that you cannot make remittances for these purposes. Now these restrictions, they include that remittances cannot be used for trading on foreign exchange markets or purchasing foreign currency convertible bonds issued by Indian companies, and for other similar purposes. So this restriction is very important, that you cannot use these remittances for trading. This is very important. You cannot use it for trading on foreign exchange markets. You may use it to make investment in shares, but you cannot use it for trading on foreign exchange markets. Also, the individuals are not allowed to send money to countries which are identified as non-cooperative jurisdictions by the Financial Action Task Force. So this is another restriction. Now this scheme has recently seen the headlines many times, and one of the latest headline which was seen was that the RBI has tightened the reporting norms for liberalized remittance scheme. So this meant that now the RBI is seeking more information under this particular scheme, and the purpose is to improve monitoring and to ensure compliance with the limits which have been set under this particular scheme. So under this particular scheme there are some restrictions as well as there are some limits. So in order to monitor that these limits are effectively met, we have tightened the reporting mechanism. Now what happened was, currently the LRS transactions, they were permitted by the banks based on the declaration which is made by the remitter. But now the reporting has been made tighter, and now under the tightened reporting norm, daily reporting system by authorized dealer banks of transactions are to be made. So daily now transactions are to be reported. So this means that we have tightened the reporting framework. Another change which has been made is that RBI has narrowed the definition of relatives under the liberalized remittance scheme. Now under this particular scheme there is this particular category, maintenance of close relative category, and to check misuse of this particular category, RBI has altered the definition of relatives for this category. Now under this category, now with the renewed term, this definition has been aligned with the Companies Act 2013. So now under this particular category, funds can be funds can be sent or used. They can be only used for sending to immediate relatives such as parents, spouses, children and their spouses. So now we have altered the definition or made it stricter, the definition of relatives. Now RBI has also recently made PAN mandatory for anyone using this scheme for remitting money outside the country. So this is another change which has happened, and it was also in the news recently. So we have to remember all these things about liberalized remittance scheme. So now we can easily answer this particular question, that the first statement which says that LRS is a facility provided by RBI for all non-resident individuals is not true, because this is a facility which is provided to all resident individuals including minors. So guys, here we end our today's discussion on some of the very important MCQs on finance. Thank you guys. If you found this video useful, please like the same and share it with your friends, and for more similar videos please subscribe to our channel on YouTube. Thank you.